investment strategies help you gain the most from your investments. Your strategy should align with your goals and time horizon, as well as your risk capacity and tolerance. For example, a buy and hold strategy allows you to ride out short-term market dips and invest in long-term growth. It can also reduce transaction costs and minimize tax burdens from capital gains. 1. Long-term investing. Long-term investing is a strategy in which you invest your money with an eye on financial goals far in the future, like retirement or college education. It's often more challenging to achieve than short-term investments because it takes a lot of patience and requires you to stick with your plan in the face of market volatility, but it can be an excellent way to build wealth over time and secure your financial future. One of the most popular long-term investing strategies involves buying stocks. With this approach, you look for companies that you believe will steadily increase in value over the course of 10 years or more. You also buy stocks with high dividends and reinvest them, taking advantage of compound interest to boost your growth potential even further. Another option is to use a low-cost index fund to capture the market's overall performance. This is a great way to diversify your portfolio without spending too much time analyzing individual stocks. It can be a good strategy to consider when you're new to investing or are concerned about the amount of time you can dedicate to the market. You might also opt for a value investing strategy, which aims to find undervalued stocks that aren't being recognized by the stock market. This is a classic Warren Buffett strategy and focuses on buying stocks that are either below or at their intrinsic value. While it's not as exciting as learning about the latest technological innovations, it can be a solid way to get a healthy return on your investment over time. It also helps if you can focus on your financial goals and ignore the noise that the market and the media tend to generate. $2 cost averaging. Dollar cost averaging is the strategy of investing fixed amounts at regular intervals, regardless of whether the market or a particular investment is up or down. This helps smooth out the effect of volatility on your investment purchases and allows you to buy more when prices are low and less when prices are high. Trying to guess exactly when the market or a particular asset will hit its peak or bottom is essentially impossible, even for professional investors. As a result, many people who want to invest miss out on acquiring assets at favorable prices. Using dollar cost averaging to invest in a volatile market, however, can make it possible to purchase shares at an average price that's lower than what you would have paid had you invested all of your money in a lump sum. For example, assume you wanted to invest $10,000. If you invest this amount in a stock that has a share price of $50, your average purchase price will be $6 per share. On the other hand, if you were to invest this same amount in 4 equal purchases made price of $54, you'd get an average purchase price of $3.70 per share and be able to buy 135 shares. This makes dollar cost averaging ideal for establishing a steady buying habit and eliminating the need to worry about timing the market. In addition, it can help prevent you from getting overly enthusiastic in a rising market and ending up paying too much for an investment that's already reaching its peak. Finally, it can help you avoid a common behavioral bias known as anchoring. Anchoring occurs when you hold onto an investment bought at a high price and refuse to sell it when its price declines. Step 3. Market timing. Market timing is the practice of trying to anticipate market lows and highs in order to buy or sell stocks, exchange-traded funds, ETFs, and other assets at the most favorable prices. While this investment strategy may seem straightforward, it's actually extremely difficult and time-consuming. It also relies on perfect timing which is functionally impossible for most investors. While there is no uber-comprehensive study of all market timers, smaller studies have found that most retail investors who try to call market lows and highs fare poorly. This is because the short-term direction of markets and individual stock prices are almost random, and it's nearly impossible to get every call right. As a result, market timing tends to have a bad reputation, and many people avoid it altogether. This is a shame because it can be an effective tool for those with limited time and resources. However, it is important to not misinterpret the negative research and opinions on this strategy as a recommendation to avoid any active management of your portfolio. Instead, consider market timing as a complement to your overall investment strategy. If you have a specific goal in mind, like a wedding in a year or a child's college education in 15 years, a targeted strategy can help you get there faster with less risk. By identifying your goals and investing according to those objectives, you can create a well-diversified portfolio without the hassle of trying to predict market lows and highs. If you do this using a proven system like VectorVest, you'll be on your way to long-term wealth while also avoiding the time-consuming and expensive task of trying to manage your own money. Fact 4. Portfolio diversification. The best way to reduce the risk of major losses in your portfolio is by diversifying your investments. This means investing in a variety of assets such as stocks and bonds. A diversified portfolio is also comprised of different sectors and even international companies. Investing in alternative investments such as commodities, real estate, and private equity can also provide additional diversification to your investment strategy. A key factor in creating a diversified portfolio is choosing investments that are uncorrelated with one another or behave differently under different market conditions. This is called effective diversification or optimal diversification. It takes a different approach to diversification than the simple "don't put all your eggs in one basket" adage, and involves performing due diligence to find assets that don't move in tandem with each other. For example, if you own shares in 2 different companies that offer similar products or services, they are considered correlated and will have a negative impact on your portfolio if both share prices decline. Conversely, if you own shares in a package delivery company and another company that offers video conferencing platforms, these are not correlated and will decrease your overall portfolio's risk. Asset allocation, diversification, and rebalancing are the primary tools that help to manage investment risk. While they may not be completely effective in reducing risk under certain market conditions, they can be beneficial for investors who are willing to accept a certain amount of volatility over time. Diversifying your portfolio requires the acceptance of uncertainty, but it can be an important part of achieving long-term investment goals. By adopting a long-term investing strategy and diversifying your portfolio, you can limit the impact of volatility on your returns over time. 5. Asset allocation. One of the most fundamental concepts in investing is asset allocation. It divides your investment portfolio among different categories of investments, such as stocks, bonds, and cash. Each category has different levels of risk and return, and they behave differently in various market conditions. The mix you choose determines how much risk you're willing to take on your way toward reaching your financial goals. It's often a good idea to diversify the assets in your portfolio and to rebalance them regularly. Rebalancing involves selling some investments to offset gains in others and buying more of the underweighted investments. Asset allocation is an essential strategy in building your nest egg for retirement and other financial goals. A variety of factors go into deciding which investments make sense for you, including your goals, age, and risk tolerance. It's generally a good idea to seek professional advice for this aspect of your investing strategy. There are many different approaches to asset allocation, but most of them focus on spreading out your investments across different categories. Value investing is a popular approach that focuses on finding undervalued investments that are likely to rise in value. Growth investing is another popular approach that focuses on companies with growing earnings or revenue. Investing your money is the most important step in creating a strong foundation for financial success. There are a number of different investment strategies that can help you achieve your objectives, from stock market timing to dollar cost averaging. Using these investment techniques can help you build your nest egg for the future and reach your financial goals more quickly. By combining these strategies with wise debt management and intelligent resource planning, you can increase your wealth over time and retire comfortably.